Okay, let's untack this. We've got a stack of sources here diving deep into Intercontinental Exchange, or ICE.
Right.
Think of this as our mission together. Cut through the noise, get past the jargon, and really extract the essentials of what makes ICE tick as a business.
Sounds good.
We're looking at it as potentially a quality growth company, one that might compound value across different economic conditions, good times and bad.
Uh-huh.
So we'll dig into its structure, the growth drivers, and maybe explore where there's some real torque if certain markets move its way.
Yeah, the material gives us a really detailed look under the hood. We see the different business segments, how the acquisitions fit together, their market position,
And the financial outlook,
and
yeah.
the financials, exactly.
Okay, so let's start high level. What's the foundational idea we should have about IC?
Well, what jumps out from the sources is how ICA has been deliberately built over 20 years through M&A.
Right.
It's basically a collection of businesses that are often monopolies or duopolies in their specific niches.
Right.
And the thinking is it's a GARPy named growth at a reasonable price. It looks positioned to keep compounding, growing earnings, even if the overall economy is kind of slow.
So it's not just random buying, there's a clear strategy.
Oh, absolutely.
Yeah.
There's a very consistent M&A playbook. They buy companies to boost their tech platforms,
Okay.
integrate the services for customers, and, crucially, they find big cost savings in the businesses they buy. They often go after dominant players where they see room to streamline.
Like with Ellie Mae and Black Knight.
Exactly. Those big mortgage tech deals fit the pattern perfectly.
And putting those pieces together results in a particular business mix, revenue-wise.
It does. It creates a pretty robust and balanced mix. If you look at the 2024 forecast, about 52% of the revenue is predictable, recurring stuff.
Like subscriptions.
Subscriptions, long-term contracts, yeah.
Wait.
The other 48% is transactional, so it moves with market activity.
That gives them stability, but also some upside potential. Now, the sources break IC down into three main reported segments. Can you walk us through those?
Sure. The biggest is exchanges. That's about 53% of revenue.
Okay.
Interestingly, it has less recurring revenue, only about 29%, but it's the most profitable by far. We're talking 75% operating margins.
Wow, yeah. That makes sense for a marketplace. Build it once, high margin on each trade.
Precisely. Then you've got fixed income and data services, or FIDS. Yeah, it's about a quarter of the business, 25% of revenue.
And that's more recurring.
Much more. About 80% recurring revenue and still very healthy margins, around 45%. This is mostly data, analytics, bond market stuff, built largely through acquisitions.
Got it. And the third piece, mortgage technology, where those recent big deals landed.
Yep, that's the one. About 22% of revenue, also high recurring, around 77%, but the margins are currently lower, about 36%. That's where you see a lot of the integration work happening now with Ellie Mae and Black Knight.
So different characteristics, but the sources mention a kind of common DNA across these segments. What are those shared traits?
Yeah, this is really key to understanding ICE. Across the board, they're providing digital solutions for things that used to be manual or just less efficient.
Okay.
These are mission-critical services for their customers. The financial plumbing.
The plumbing, right.
They operate on platforms, which lets them layer on more services.
Yeah.
Monetizing data is huge for them, too. And like we said, they usually have monopoly or oligopoly positions.
Moats.
Very strong moats. And financially, they're capital light with really high incremental margins. So a new dollar of revenue costs very little to bring in.
That thread really ties the strategy together. Let's zoom in on exchanges, the biggest piece. What exactly are exchanges and clearinghouses doing here?
So think of the exchange as the central marketplace, the digital square where buyers and sellers of contracts meet under set rules.
Right.
The clearinghouse is the critical bit in the middle. It guarantees the trade completes, managing the risk that one side might default. It does that mainly by making participants post-margin, like collateral.
And why are these such good businesses, beyond just the high margins?
Well, there are powerful forces at work. First, network effects. More traders mean better liquidity, tighter prices.
Which attracts more traders.
Exactly, a virtuous cycle. Second, once the platform's built, the cost of handling one more trade is almost nothing. Third, the contracts themselves, like an ICE Brent future, are proprietary. You can't trade that exact thing elsewhere.
Ah, so if I need that contract.
You have to go to ICE for that specific contract, yeah.
Yeah.
And that leads to the fourth point, which is super powerful, collateral netting.
Okay, what's that?
If a big trading firm has lots of different positions at ICE, the clearinghouse can net them against each other for calculating margin. It's way more capital efficient than spreading trades around and posting full margin everywhere.
Ah, I see. So it pulls activity onto their platform.
Hugely. It strongly incentivizes traders to consolidate activity at one main venue, like ICE or its main competitor.
It makes that network effect really sticky. So where does ICE have these dominant positions? What are their key markets?
They're the top spot for some crucial global benchmarks. Brent crude, the global oil standard,
Right.
Dutch TTF, which is the main European natural gas benchmark, and European interest rate futures. They also do other commodities, index products, and obviously cash equities through the New York Stock Exchange.
NYSE, yeah. And the money comes mainly from trade fees.
That's the biggest part, yeah, the fee per contract, or RPC. But they also make good money from interest earned on all that margin collateral they hold.
Okay.
Listing fees from companies on the NYSE and selling market data and connectivity.
Who's the main competition here?
In futures and options, it's really CME Group. They compete across the board, but they each have strongholds. ICE dominates Brent, TTF, European rates. CME leads in U.S. rates, U.S. oil or WTI, and U.S. gas, Henry Hub.
Right, different geographic or product strengths.
And for listings, NYSE competes with NASDAQ and others globally.
Okay, let's get into the growth drivers for exchanges. The sources highlight some really interesting structural shifts. What's happening with oil futures?
Yeah, this is a great example of a structural tailwind helping ICE directly. The global oil market is just getting more complex, flows are changing.
How so?
A key thing mentioned is that starting in May 2023, WTI, the U.S. benchmark, was actually included in the Brent benchmark calculation.
Wait, how does putting the U.S. benchmark into the global one help ICE? Brent is their strength.
Because WTI now directly influences the Brent price. So traders who maybe only focused on Brent before now have to pay attention to WTI, maybe trade WTI-related contracts.
Okay.
And because of that collateral netting advantage we talked about, the most efficient place to trade both Brent and the related WTI stuff is on the same exchange, since ICE owns Brent.
They're pulling in WTI trades too, even though CME is the traditional WTI market.
Precisely. The data is pretty stark. ICE has like 93% of Brent, CME has about 81% of WTI, but ICT's share of WTI contracts has jumped from 17% in 2021 to about 26% now.
Wow, that's a big shift, a 50% increase in their share.
Yeah, so ICE is really outpacing CME in overall energy volume and open interest because of this.
That's a fundamental market change playing right into their hands. What about natural gas and LNG? Sources talk about supernormal growth there.
Oh, the acceleration in natural gas trading, the ADV, it's been incredible. It was crawling at like 1% growth per year from 2014 to 2019.
Pretty flat.
Yeah, since 2019, it's exploded to a 15% compound annual growth rate. Last year alone, up 30%.
Whoa. What lit the fuse on that?
A few things coming together. One is just the massive growth in global LNG exports, especially from the U.S.
Right.
Demand's also up as coal plants shut down. And then, of course, the war in Ukraine completely scrambled European energy, driving huge demand for global LNG and breaking old supply lines.
And is the way gas is traded changing too?
Yes, that's another key piece. It's moving away from those old, long-term government-to-government deals.
Okay.
Now it's shorter durations, more middlemen, more complex pricing that isn't just tied to oil anymore. All this complexity and global movement creates a much bigger need for risk management on exchanges using standardized contracts.
So more gas moving physically and the trading around it is getting more dynamic, more suited for exchanges.
Exactly. And the future potential looks massive. Global LNG supply capacity is set to jump 40% between now and 2028. Physical LNG trade could double in 5 years. Every single ton moved or hedged is a trading opportunity for ICE.
You also mentioned something called the churn factor for gas. What's that?
Right. Churn is basically how many times a unit of a commodity gets traded in futures or options before it's physically delivered.
Like velocity of trading.
Kind of, yeah. Think about how often a stock share trades versus how often the company sells its product. For nat gas, churn is estimated around 10% right now. That's really low compared to oil markets. Even within gas, European TTF churn is only half of U.S. Henry Hub.
So the trading intensity isn't as high as it could be.
Right. If the gas market keeps globalizing and maturing, that churn rate could climb significantly. If it does, trading volumes could keep growing fast, even if the underlying physical market doesn't grow quite as quickly. It's like unlocking more trading activity within the existing market.
Fascinating. Growth from the platform itself becoming more active. So given all that, what's the outlook for the exchanges segment?
Well, based on these tailwinds, the sources figure that even if growth moderates a bit from these crazy levels, say 18% volume growth this year, maybe 15% after.
Still very strong.
Very strong. Plus price increases. They expect exchange revenue to grow around 11% a year medium term. And because of those high incremental margins, operating margins could push up from 75% towards 80% by 2027.
Robust growth and margin expansion from the core business. Okay, let's pivot. Fixed income and data services, FIDS. What's the scope here?
FIDS basically provides data, analytics, and some execution services all around the bond trading lifecycle.
And the main parts.
The biggest chunk, maybe 80% of the segment, is fixed income pricing data, analytics tools, global indices.
Like benchmark indices.
Yeah, huge benchmark indices, plus ESG data for fixed income. Then about 15% comes from IC Credit Clear, their clearinghouse for credit default swaps. And the last 5% is from actual bond trading platforms.
How do they build this? Was it organic?
Mostly M&A again. This is another example of their playbook. They weren't historically big in data. Big deals like Interactive Data Corp back in 2015 gave them a lot of pricing and analytics muscle.
Right.
And they bought Bank of America Merrill Lynch's index business, which they've grown into the second largest fixed income index platform globally. Trillions benchmark to it.
Different competitors here than in exchanges?
Yeah, definitely. In data and analytics, they're up against giants like Bloomberg and Refinitiv. In trading, it's firms like Tradeweb and MarketAxess. Growth here has been steadier, maybe 6% revenues KGR recently, but it's very recurring and has good incremental margins, around 67%.
Okay, solid, steady business. Now, third segment, mortgage technology. This is where Ellie Mae and Black Knight fit. What's the big ambition here for ICE?
The goal is really to digitize the entire U.S. mortgage process end-to-end, from origination when you apply,
Right.
all the way through servicing the loan over decades, and even handling things like foreclosures if they happen.
And the key pieces they assembled.
The core are those two huge acquisitions. Ellie Mae in 2020 brought Encompass, a leading loan origination software, or LOS.
Okay.
Black Knight in 2023 brought MSP, the dominant mortgage servicing platform. Those two are the heart of it. They also own MERS, Simplifile for closing, DDA for documents, lots of pieces.
What's the problem they're solving for banks and mortgage companies?
Fundamentally, the U.S. mortgage process is just super inefficient and expensive. The sources quote figures like $11,000 average cost to originate one mortgage,
Wow.
and like 2/3 of that cost is people. ICE thinks their tech platform can slash those costs, which is critical for lenders, especially now when margins are so tight.
How does the revenue work here? Is it per loan?
It's mostly subscription-like. For servicing on MSP, it's usually an annual fee per loan they service, plus extra fees for things like foreclosures. For the origination software Encompass, it's typically a fixed fee per user, plus a smaller fee per loan originated. Then network stuff like Simplifile is more transactional.
And the current market,
Yeah.
not great for originating mortgages, right?
No, it's really tough. Interest rates hammered refinancing. Purchase activity is low. Originations and foreclosures, which drive some revenue here, are bumping along near 20-year lows.
So what's ICE's position in this difficult market?
In origination, with Encompass, they have roughly 50% share, historically stronger with smaller lenders. They actually had to sell off Black Knight's competing platform, Empower, as part of the deal approval.
All right, the divestiture.
Yeah. On the servicing side, with MSP, they are the clear leader. They service something like 62% of all first lien mortgages, maybe 54% overall. The main competitor there is Sagent.
Now, here's an interesting point from the sources. Despite the tough market and that divestiture, ICE has apparently had really strong sales success recently, even if the numbers haven't fully reflected it yet. What's going on there?
Yeah, this is super important for the future outlook. Since the Black Knight deal closed, ICE has announced a whole series of major new customer wins and cross-sales. Big names: JP Morgan, M&T Bank, Raymond James, Citizens, Webster Bank. Over 50 others just for Encompass. They've signed new MSP servicing clients like Fifth Third and Lunner. They're cross-selling other tech like DDA to big existing clients like JPM. MSP apparently just had a record quarter for new client additions.
So they're definitely winning deals and taking share.
Absolutely. Just the announced Encompass wins alone are estimated to add something like 6 points of market share in origination.
But if you look at the recent quarterly results, pro forma, the recurring revenue in this segment has been kind of flat or even down slightly. Why the disconnect?
Right, there's a lag. Part of it is just lapping some older customer losses, but the main thing is implementation time.
Ah.
Getting a huge bank onto MSP or Encompass is complex. It can take 6 months, maybe 18 months, or even more for the really big ones before you see the full recurring revenue show up in the results. Yeah.
They expect these recent wins to start really boosting reported growth more in 2025 and 2026.
Why are they winning now when the market's so weak? Seems like a few factors. One, they're leveraging their existing deep relationships across finance from the exchange and data side.
Makes sense.
Two, they have a compelling story now. An integrated platform focused on efficiency, which is exactly what banks need when margins are squeezed.
Right.
And three, they're actively going after customers of that Empower platform they had to sell. Those are often larger banks who might see more value in ICE's broader ecosystem and commitment versus maybe a new owner of Empower.
Okay, but we also need to talk about a negative development. The Rocket and Mr. Cooper deal. How does that hit ICE?
Yeah, that was definitely a negative. Rocket uses ICE for servicing. Mr. Cooper uses ICE for origination. Rocket's buying Mr. Cooper,
Okay.
and the plan is the combined company will move Rocket's servicing volume onto Mr. Cooper's existing platform, which is Sagent, not ICE, and Mr. Cooper's origination volume will move to Rocket's own in-house software.
Ouch. So ICE loses both sides of that business.
Pretty much, yeah. The estimate is it's about a 5% negative hit to ICE's recurring mortgage tech revenue. Probably starts hitting around mid-2026 based on the deal timing.
That's a decent headwind. So even with that loss baked in, what's the overall outlook for recurring revenue growth in mortgage tech?
So even factoring in that 5% hit from Rocket Cooper, the strength of all those recent wins is still expected to drive recurring revenue growth around 7% a year over the next 3 years.
Okay.
It might dip to mid-single digits in 26 or 27 when that hit lands, but the key point is that's a huge acceleration from the roughly 1% growth they saw over the last 3 years.
Right.
And importantly, that growth comes without needing the mortgage market itself to rebound. It's structural growth from share gains.
That's the base case. But what about the asymmetric leverage if the market does turn? The source is called I see a loaded spring here.
This is where the torque really comes in. The transactional part of the mortgage business tied to originations is running at rock bottom levels right now.
Like 25-year lows.
Yeah, maybe 5 million originations this year versus a historical average closer to 7 to 10 million. Because that transactional revenue is so depressed.
Any recovery has a huge impact.
Exactly. Any increase from this trough level gives you a disproportionately large boost to revenue and especially margins.
So if rates fall or the housing market picks up and originations get back towards normal levels.
Right. If, say, originations recovered to maybe 7.4 million by 2027, that's like 13% industry growth a year from here. Because ICE has been winning share and might have pricing power, their origination revenue could grow even faster than the market.
Okay.
Combine that potential transactional pop with the underlying 7% recurring growth, and you could see really substantial total revenue growth in mortgage tech and huge margin expansion. The sources mentioned maybe 1,500 basis points of margin lift over 3 years in a rebound scenario.
That's the loaded spring. Now, the sources also mentioned something else interesting, almost like a free call option on future innovation in mortgage.
Yeah, these are potential upsides, not really in the forecasts yet, but exciting possibilities. One is just monetizing all the data.
From the mortgage platforms.
Exactly. All the loan details, property info, transaction data flowing through MSP and Encompass. ICE is great at packaging and selling data. They do it in exchanges and FIDS, and it's very high margin. They could create valuable data products for lenders or investors here.
Makes sense. And the second idea?
This one's maybe longer term, more ambitious. Creating a proper trading platform or clearinghouse for mortgage servicing rights, MSRs.
MSRs. What are those exactly?
Okay, so when a company makes a mortgage, they can keep the right to service that loan, collect payments, handle escrow, etc., or sell that right.
Okay.
That right, the MSR, is an asset that generates steady fees. It's a huge asset class, mostly held by banks and servicers. Right now, they trade mainly in big, private, over-the-counter deals, kind of opaque.
And ICE could change that. How?
Well, since their MSP platform services over half of all U.S. mortgages, they have incredible data and insight into most MSRs out there. The vision is to use that data, plus their expertise running exchanges and clearinghouses, to create a central MSR trading platform. Bring transparency, liquidity, maybe clear the trades to remove counterparty risk, just like they do with futures.
That sounds like it could be a massive market to bring onto an exchange.
Potentially, yeah. There's something like $14 trillion in MSRs outstanding, maybe $1 trillion traded last year. If ICE captured even a tiny slice of that trading with a small fee, say 5 basis points, that could be hundreds of millions in revenue.
Wow.
Again, it's not in the near-term numbers, but it's a really interesting long-term possibility that leverages their dominant software position.
Okay, let's pull it all together from this deep dive. Based on this analysis from the sources, what's the overall picture for IC's estimates and valuation?
The projection is for consolidated revenue growth, around 9% medium-term, mid to high single digits.
Okay.
But operating income should grow faster than revenue. That's because of the fixed cost base and the cost cuts from acquisitions. So you get significant margin expansion, maybe over 600 basis points in the next 3 years.
And how does that stack up against what the market expects, consensus estimates?
This analysis puts potential earnings quite a bit higher than current consensus, about 11% above for 2026 APS and maybe 18% above for 2027.
Significant upside to consensus.
Yeah. And in terms of valuation, the sources frame the risk-reward as pretty attractive. They see maybe 34% upside if you assume just a modest mortgage refi rebound
Okay.
versus maybe 14% downside. So that works out to roughly a 2-to-1 risk-reward ratio at current levels.
So a solid base case plus that kicker from a mortgage recovery. What are the main risks we need to keep in mind?
Okay, primary risks highlighted are, first, the mortgage market just stays in the doldrums for longer than expected.
Right.
The structural gains mean the segment still improves, but that big leverage needs volumes to come back. The sources see it as when, not if, but timing is tricky, depends on rates.
Makes sense. What else?
Second, those really high trading volumes in natural gas and Brent could cool off. They're elevated now due to structural stuff, but less volatility or a slow economy could dampen that growth.
An air pocket in exchange revenue.
Yeah, exactly. And that revenue has high decremental margins too, so a drop hurts profits quickly, though the underlying structural trend still seems positive.
And the third risk, integration.
Always a risk with huge deals like Black Knight. Integrating complex tech stacks can take longer or cost more. The sources say ICE is tracking ahead on cost savings and revenue synergies look okay with the recent wins. But, the underlying tech was apparently pretty clunky. Integrating systems that big always carries execution risk. It's not simple.
Absolutely. Even with a good playbook, these are huge integrations.
For sure.
Okay, so bringing it all together from the sources you've analyzed for us, ICE looks like this powerful infrastructure business. Dominant, sticky positions in exchanges, data, and now increasingly U.S. mortgage tech.
Right.
Clear structural growth in energy markets driving share gains. Significant asymmetric potential in mortgage from those recent wins and the eventual market rebound.
Plus those interesting long-term options, like data and MSRs.
It really seems like a business combining stability from those recurring mission-critical services
Yeah, big plumbing.
with compelling growth potential from market shifts and smart M&A.
It's quite a mix. Stability and potential upside.
It really makes you think, doesn't it? How a company that's basically the plumbing for global finance finds these powerful, maybe overlooked growth engines hiding in plain sight.
Yeah.
Whether it's the growing complexity of energy trading or just the deep inefficiencies still left in something as basic as getting a mortgage. How does that blend of being essential infrastructure but also driving innovation in those areas shape where they go next? It's quite a lot to consider.